Keith McCullough, and welcome back. Changed the team up here. We got Chris Ciovacco in. I'm just saying, it was a great hockey name, Ciovacco. He said, I wish my first name was Butch. He's going to go to the Rangers game. You're going to go to the Ranger game this week, right?
I am heading to the Rangers game against the Sharks.
Yeah, that's good. He was also saying that the tickets are cheaper because our Rangers suck so far this year, but yeah, that is what it is. Stock market today, it's like, down a lot. People are kind of having their little, or their latest freak out. But what I wanted to give you a chance to do is kind of go through the last, 5 years, which is really how you look at the world. Let's contextualize where we are today before we start to have a discussion on what to do tomorrow.
Right. Let's go through some easy bullet points. 2013, S&P 500 has a very long-term breakout. So visualize it. Stock market comes up in the year 2000. Peaks. We peak in basically the same spot, 2007. This time when we come up in 2013, we break out. That's different and that matters. We'll come back to that later. Then we fast forward and we get into where we start to fall again. So let's go into early 2016. We get off to the worst 10-day start in stock market history. And all this is important because it has to do with shifts. And then after that, we get, from an interest rate perspective, a big extreme. So Japan announces negative interest rates. And think about how we felt then. I literally, during this period here, is the only time in my whole career I stopped and I said, did I get in the right business? Because the central banks seem like they've run out of ammunition. We're stuck in this kind of slow growth paradigm. People aren't interested in the stock market. So extremes matter. So soon thereafter, on February 11th, 2016, the stock market bottoms. And we don't know at the time, but this is a major bottom. Major, like possibly we will not revisit this again ever if the charts today are right. Now we can kind of get into some political things and we'll talk psychology and all that. Then we come up and we get into Brexit. So we have the Brexit referendum on June 23rd, 2016. 5 days later, June 28th, another major event happens. 10-year yields bottom from a peak that starts way back in 1981. So 10-year yields in 1981 are about 15.8%. It takes them 35 years, whole careers. So that's also important because things change. So that's a major low that we get there. Right on the heels of that, we have an election in the United States on November 8th. Trump gets elected. So while all of this is happening, we've got some major breakouts occurring that are going to come on the heels of that S&P 500 breakout. So that S&P 500 breakout in 2013 told us something's different here. Why were we able to exceed the high from 2000 and 2007? Why did we do it this time? Well, markets are forward-looking mechanisms, and they're telling us that the next 15, 20, 35 years will probably look significantly different than what we had in the rearview mirror. So let's talk a couple breakouts and tie them in. So bonds come down and hit a 35-year low. And of course that's important because there's not many things in the investment world that we know with 100% certainty. What's one of them? That when interest rates rise, bond prices fall. So if you're buying bonds, down here when we're talking about negative interest rates, that's possibly the worst entry point in the history of mankind, at least in our lifetime. And that's a big change. 35 years there. Here's the other huge one. The value line geometric index is your perfect equally weighted index. So we have capitalization weighted indexes where it gets skewed by a handful of stocks. The value line geometric index is rebalanced all the time, and it's equally weighted.
How many stocks are in there?
I think it's about 1,500,
so
15 to 1,700, very broad. So what people use it for is this is an excellent way to track the performance of the average stock. And this starts to get really interesting here. That index came up in 1998 and peaked 2 years before the major indices. So there's your market breadth problem. Breadth actually peaks 2 years before the dot-com bubble bursts. Then we come down, we come back up to basically the same area in 2007, that same kind of peak, and we aren't able to do it. We come back to it in 2015 and hit resistance and stall, and this is where we come into the election and things like that. And just now, over the past 12 months or so, we have a 35-year breakout in there. How do we get 35 years? When you come down in 2009, inside, think this is a consolidation box. We go up, hit the bottom, we hit the top, resistance, come down. When we come down in 2009, unbelievably, the average stock, or the value line geometric index, falls back to levels seen in 1982. You're in that box for 35 years. Mm-hmm. The entire time, interest rates are doing what?
Straight down.
They're falling. Mm-hmm. So it kind of tells us one thing about the thought that interest rates falling is good for stocks. It's kind of coming into question a little bit here. Here's why. Interest rates started to rise in 2016, and now we have all these bullish breakouts all over the place. NASDAQ clears the high from 2017. Stocks versus bonds. So if you look at the S&P 500 versus 10-year yields, we have this, it's like a cap that's put on it. Resistance, resistance, resistance. Bonds breakout versus stocks. So what does all this mean from an investment perspective? It basically says that if you're building your little pie chart and you're going to a firm that's using data that looks backwards, possibly everything we know over the past 35 years is going through a major shift. Why? Because if interest rates have bottomed, and let's say that is the low, and right now that's what the charts say, that's the low. We're probably not going back there maybe in our lifetime. If that's true, then REITs, master limited partnerships, bonds, dividend stocks, all of them that have had a major tailwind for 35 years because interest rates are falling, have now shifted to a major headwind. And the tailwind now is moving to the stock side. So that's pretty big stuff. That says a lot of this pie chart, robo-advisors, things like that are supposedly magically going to save you. What they expect to have happen, the market's telling us, not an opinion. These breakouts are real. You can see them on a chart. The market's telling us that something's changed. And one of the quotes from the book Market Wizards is, no matter how many people tell you when the market makes a new all-time high that it doesn't matter and nothing's changed, the sheer fact that we've made a new all-time high tells you something's changed. So we have a lot of changes here. Small caps right now as we speak in this calendar year on a quarterly and annual chart, trying to break out versus long-term treasuries. Technical analysis, the longer you go sideways. So this is indecisiveness. We're confused. We don't know whether we want to own stocks or bonds. The longer we go sideways, the bigger the move that we can expect to get when we either get a bullish breakout or bearish breakdown. Mm-hmm. So these are major shifts that are coming, telling us too that what you do, data dependent, works in this environment. You're not looking at data and building a pie chart. You're actually looking at the facts that you have in front of you today. If you're piloting off of facts, you're fine, because you're seeing what's in front of you and you can adjust. If you're building off of historical data only and trying to anticipate things, here's a good example. If you own bonds in your portfolio, have you been happy with those lately? Have they been helping? Not really. When we had a correction earlier this year, did bonds work as a hedge? Nope. We came down in January, bonds didn't do well. Today, right now, when stocks are falling, are bonds helping you out? They're not. That's different than what happened inside of that big box. So when we have problems in 2011, when the stock market's struggling, stocks do help you out. TLT in the ETF world kills it in 2011. There's one other thing that's kind of neat. 2015, two other things, and then we'll pick this apart. And I'll be quiet for a minute. We're supposed to be having a conversation. 2015, you can find a Bloomberg article. It's the year nothing worked. Stocks, bonds, and cash, right, sideways. What is that? It's major indecisiveness. Indecisiveness occurs at major turns. Major turns. And then we've got another one that ties in. Then we go to demographics. 2016 is a very rare year. Only 3 times this has happened. It's known as an outside year on an annual chart. So if I'm looking at my candlestick, what happens, so I'm looking at an annual stick. So I've got a 2015 stick and a 2016 stick. In 2016, we exceed the lowest low from 2015. Then we exceed the highest high from 2015, and we close above it. That is, I call that the nimble barge. Markets normally move slowly. You get a big peak in 2000 that takes several months for the market and the technicals to roll over. 2007, you can see evidence rolling over. The barge takes a little while to turn around. 2016, the barge looks like it's turning. We get off that worst 10-day start. Then the barge figures out it's wrong, and it quickly reverses. That's really bullish when that happens. So that outside year, the last time that outside year, which occurred in calendar year 2016, last time it happened, 1982. What happened after that? Secular bull market that lasted 18 years. Now look, we keep going back to the early 80s. Rates peaked in 1981. Now we've got this outside year that's very similar to 1982. And there's another interesting analogy in here, and it's demographics. So if you've been in this business a long time, as we have, we're all pretty much familiar with the Business Week article from the 70s, late 70s, The Death of Equities. They put it right on the cover, like it's over. I think it was 78, 79, somewhere in there. 2 or 3 years later, we start an 18-year bull run that just knocks the cover off the ball. Death of equities, my you-know-what. We'll bleep it out. So that's not what you have there. And there's a really interesting tie there as well. Sentiment is skeptical. You don't write something called the death of equities if everybody thinks the world is great. There's a lot of skepticism, and we can tell you exactly why. Why are we skeptical? We can look at that. 1982, the baby boomers, the greatest generation, they're roughly sitting around 20 to 35 years old. They're entering the workforce. They're that prime, meaty part of the workforce that does the work. Fast forward to 2017, millennials, larger than the baby boomers, 20 to 35. They're in the exact same demographic sweet spot that the baby boomers were in 1982. Let's talk sentiment now. People look backwards and they say two things. First of all, valuations are going to kill this theory. There's no way. What these theories are telling you is that a 1982 to 2000 type secular run is what we're in now. This is not the end. This is the beginning. You don't have a 35-year low in interest rates at the end. This is a major shift that's occurring. You don't get the average stock breaking out of a 35-year base at the end. At the end, you come up to resistance and you fail. So these are major shifts that are going on, telling us these backward-looking pie charts, these stagnant approaches to money management versus a data-based approach, could produce very, very disappointing and confusing returns. Let me hit two things, and I'm going to be quiet and we can talk. Number one, this will end badly. So we've got a whole generation of people, this will end badly. Let's just do some easy math here to make it easy. Let's say in the year 2000, I was 10 years old. Today, I'd be roughly 28. If I was 50 in the year 2000, I'm 68 today. So I think it's pretty fair to say that the vast majority of market participants fall into that category. Today, 28 years old to 68 years old. When they look backwards, all they know is this will end badly. This will end badly. That's recency bias. We feel that way. You would have felt the exact same way in 1982. If you look backwards in 1982, this ended badly, this ended badly. You're going through these periods of secular trends that last a long time. The market needs to consolidate its gains. That's when we go sideways. So you go sideways from roughly the late 60s into 1982, which is very similar to the period that we just went through of the indecisiveness. So the last kind of piece of that would be, so the psychology is easy to explain. If you feel like there's no possible way this could happen, that's how you're supposed to feel. That's how they felt in 1982. That's how they felt in the early 1950s. And oh, by the way, employment today looks a lot like the 50s. The 50s is the beginning of a secular move that lasted from, depends where you start. You can start in 1950, maybe 1954, and you can either end in the late 60s or a peak in 74. When you actually get to that peak, you're already starting to consolidate. You just don't know that. You're in the box, but you don't know it yet. So in the move that we went through, 1995 to 2000 is really part of the consolidation box. We just don't know that yet. And usually those moves are fully retraced. This probably isn't a 1995 to 2000 move. And bases tell you why. When you're up at here in the year 2000, you're way, way far away from a base. We all know that the steeper the slope gets, the harder it is for that trend to continue. So when you get up in 1982, your base sideways consolidation's way down here. It makes sense that you run into problems. Markets needs to consolidate its gains. You just can't keep going straight up. That's not where we are today at all. We have bases like we can step on them. They're right behind us. The NASDAQ just broke out of a massive base. So these are big, big changes. And when you look at them all together, especially if you look at long-term charts, you can also look at charts and just easily debunk the case that this is 2000 all over again. The momentum today looks nothing, not even remotely close to the peak in 2000. And the peak in 2007 is a lane peak because that's a consolidation peak. So that's not really where we are either. That's in the middle of a consolidation box. We're at the front end of a consolidation box. So these are big, big changes that aren't talked about a lot. Why? How many people are looking at 100-year charts of the S&P 500? How many people are performing technical analysis on a chart of the Dow during its entire history? How many people are doing long-term technical analysis on a quarterly chart, an annual chart? And market fractals tell us that the technical analysis that we do on a 1-minute chart, a 60-minute chart, a weekly chart, it's identical on a quarterly and annual chart. It works exactly the same way. I have DeMark software. So the way I track the market is with that. That's just kind of the chart I look at. So you're constantly, you can go to 1 minute, 10 minute, 15 minute, 30, 60, daily, weekly, monthly, quarterly, annual. But the thing that's cool about it is if you take those price movements and you pulled the scales off and laid them on the floor here and said, Chris, who has been studying charts since the 90s, I got the little chart books they used to put on my desk. That's no internet then. If you pull the scales off, you can't tell the difference. The price movements, they're not close. They're identical. So when you're in a 1-minute chart, you have little mini bull markets, little mini retracements. So these market fractals are telling us that we should be open to. This is the key now. Everything we're talking about is based on the facts in front of us now. You're a database shop. You look at facts. We're a database shop. We look at facts. We're not forecasting anything here. We're just simply saying this is what the charts are telling us. And they've been telling us this for quite some time. So we put out a piece in August of 2016 that said this breakout's only happened 10 times in the last 30 some odd years, telling us to keep an open mind about better than expected outcomes. And actually, you think about psychology. When we break out in 2013, I see that, I write about it. But when we get into all the mess in 2015 and 2016, I forget about it. Why? This will end badly. That's still where we are. And when you start to turn in 2016, it looks identical to the beginning of a bear market. Asset class behavior is identical. Your charts are identical. So in our shop, we did migrate to a fully defensive position, which I do not regret. That was absolutely the right thing to do. But the difference is you have to be flexible enough to migrate back. And that's why I think what you do and what we do and what a lot of the really big, see, what you do that's different than what we do is your research and what we do is available to the average investor. A lot of this stuff's done at very, very high levels that are managing billions and billions of dollars. Most of us that are down at this level here are doing things like I fill out a profile, I tell them what my risk tolerance is, how old I am. They go to a database and they build me a pie chart that's looking backwards. So it's the equivalent of building a pie chart looking backwards in 1982. well, that pie chart would have been really messed up.
Yeah.
It would not have helped you. All right, guys, fire away. That's a lot.
Yeah, the pie charts that is a lot, but it's important history. I mean, people need to go back and review, and if anybody had an issue with what you said, then they'd give you feedback, and you'd say, well, maybe I didn't think about it that way, but by the way, this is what I was looking at. I mean, everybody can contextualize history the way that they want, but they can't go back and restate price action. You can't go back and restate the time series. You can't go back and restate who is the president, therefore that's why the time series looks like that. I mean, that's not, I think it's very consistent actually. Like when we take our views, the biggest difference is that we're not just looking, we're looking at the time series is God to us.
Sure.
We have to, the further back you can go in the time series, the better.
Sure.
The problem with volatility data is it doesn't go far back enough.
I know. There's a lot of things we don't have a lot of data on.
So
It's true.
when our quantitative signaling process really hinges on vol, because we fundamentally believe, because market history does, that when vol enters an asset class's life to the upside, the beginning of the end or the beginning of the outflow in that asset class starts to occur. So we're trying to use the fundamental piece, which are the two causal factors, which Dalio has proved out, with 1,400 people. So I don't think that, whether people disagree or agree, I don't particularly care. I mean, it's growth and inflation are causal factors on pretty much everything that you just said.
True.
So when
it's all related. It is, and that's one important part about your story. You should be able to take your story and rip it apart from different angles. So when people send you the what about question.
Yeah, those are brutal.
But they're good because you need to water test it. And
you have to consider it, but you don't have to get lost in it. Nope. You actually wrote this to me, and this is actually a really important point. If we keep skipping from one approach to another, it's difficult to make prudent and good decisions. I mean, that's what people do, Chris, in markets. They are going from, we call it going from headline to headline. We call them macro tourists. That I'm not everybody's favorite person out there because I call them names. But if you're a monkey or if you're a tourist, you deserve to be called one or the other. If that's what you're doing every day, that's not helpful.
It's hard not to do it, but people do it. You're right.
But that is the ultimate recency bias. So as a starting point, that's where people are at. Okay, for Chris to come in and go, let's go back to 2013. That's a much more reasonable.
Well, why are they there?
Yeah.
Why are they there? If you want to learn about the markets, I'm not so sure that you should turn on CNBC, and I'm not knocking CNBC or any of the financial channels. You could say it about them all. They're in the advertising business.
Yeah. Mm-hmm.
That's what they do. And as viewers, we need to understand that. So when we turn on the TV, we need to know what are they trying to do. They're trying to create, and we all do it, by the way. I'm not being critical. Mm-hmm. So when I put out a weekly video every week, I try to come up with a headline that, if you're going to do the work, you want someone to click through. So this is not unique to them. We all do it. If you put out a report that the whole office worked on for a year, you would want to have some kind of catchy headline. The important thing for us is we have to understand what business they're in and what they're trying to do. They're in the eyeball, click, and ad revenue business is the business they're in. And if they came on every day, imagine if you would turn on CNBC and we're in the middle of a secular bull run and you should hang out. You shouldn't do a thing.
Yeah.
You wouldn't turn it back on. And I want to make something very clear here. Even if all this happens, Keith, it's not easy.
No.
Is it easy from 1982 to 2000? It's not easy at all. We have Black Monday in there. We have currency crises. We have a 20% drop very quickly in 1998. So my point is, even if all of this is true, market fractals tell you that there's all kinds of different things happening, little mini bear markets, trading opportunities, shifts from sector to sector. So even if all of this were true, if it comes out, so let's say we're in the middle of an 18-year bull run here that started sometime between 2013 and 2017, which would mean that we have quite a ways to go. If that's true, it won't feel that way in real time. It will never feel that way.
Yeah, how it feels. I checked that at the door right at the beginning.
The markets aren't doing well today. How does it feel? It doesn't feel good.
Yeah, but the feel and the whole, even today we're back to, in as much as there's a fear, an embedded fear on what's already happened. If you're 20 years into this, like me and you're however many years you've been in it, we've crashed twice. So you're sitting there, and you still have guys like Joe Kernan bloviating that well, you're just on the Dow from like 800 to 27,000. What do you have to worry about? Then why are we watching you, Joe? Like, why are you talking today? Like, if you don't have, so you have a whole host of things where people have come to forget the risks associated with things going down. I mean, you could equally say that there's a secular bear market in emerging markets. You could say that there's whatever you want to say, you should say it, but you should at the end of the day you have to renew your view with data every day in your process.
This is the way we say it. We always say, am I allocated properly today based on the facts in front of me today? If the answer is yes, leave it alone. If the answer is I'm not sure, leave it alone. If the answer is no, so you're constantly you don't want to look for things that support your thesis. You're looking for things that will poke a hole in your thesis.
100%
so you'll say, hey, I'm not there. And Keith makes a very good point about risk management. You have a 50% loss at the wrong time in your life. It doesn't matter how.
That's horrible.
It is. Not only is it's horrible psychologically, it's horrible for your family, even though it comes back. And the problem is it does come back, but we're humans. So even if your pie charts work, they do work. So if we look backwards from today and I hold my pie chart through all of these disasters, I'm probably doing okay today. Mm-hmm. It's next to impossible to hold through the disasters. When you're down 30%, you say the pie chart's broken. It's supposed to be helping me.
Yeah.
So you're right. You do have to. You always have to have an exit strategy.
When people say that, now that I have 4 children, I'm like, okay, theoretically, upon birth we can leave them and I can come back in 18 years, and I hope and they should be okay. But there's a whole hell of a lot of stuff that happens in between every single day, every single week, every single year, and that's called living. If you choose to live the market life, then live it and try to make money on it. I mean, this is to us. I think this is where we're quite similar. But let's just go back in your and
the timeline.
We'll have questions from the audience that I'm sure coming in. Ben's going to do those. But you go back to 2013, like in our model.
Right.
I can summarize this in less than 2 minutes. 2013 growth, because again, what I care about, I do have a quantitative signaling process.
Sure.
Again, I built it on my own. It's what I see, it's what I think. But the growth and inflation story is very simple. In 2013, U.S. growth accelerated in rate of change terms. In as much as you can get...
Hence the breakout.
The breakout. Growth, when growth breaks out, growth is a causal factor that drives growth stocks up and drives bond yields down. Okay, so you had it.
So the charts nicely align with all that.
Growth and inflation accelerating at the same time, we call that quad 2. Mm-hmm. When both are slowing at the same time, mm-hmm. which started in 2015 in earnest and then effectively capitulated to the lows in 2016, the average decline of the Russell 3000 was 38%. So did growth slowing matter in as much as it mattered on the upside? Absolutely did.
It does.
Okay. Inflation fell precipitously. If you go to slide 15 in the current slide deck that I just threw up there, if you go right back to 2015, 2016, you could see what was inflation there, Chris. It was 0, right? When inflation goes to 0, bond yields went to the all-time lows.
Right.
The number one predictive value for inflation, or for bond yields rather, is the rate of change of inflation. Mm-hmm. So lo and behold, bond yields go up for the last 3 years, and I think, Josephine, you probably have a chart ready of the 2-year yield. And what has the 2-year yield done? Because that's a reflection of inflation accelerating, growth accelerating for 9 quarters in a row. For 9 quarters in a row, Chris. Starting, yes, in Q3 of 2016.
And think about that 9 quarters in a row after these breakouts.
9 quarters in a row. That's where you could have made all your money.
9 quarters in a row is what the early stages of a secular trend is supposed to look like. The early stages are easy. And I'll say this now, for some of these moves, we're out of the easiest stage. There's an indicator called ADX that looks at the strength of a trend, and it's kind of a sustainability thing. So this is the, what about 1987? What about 1998? 1987 and 1998, remember your base. The further I get away from the base, the riskier it is. When you get to 1987, black ADX, because I'm simplifying here, is extended in a way that it's never been extended before. When we compare today's readings to it, it doesn't look anything like that. It's not even on this. And then if you come over and you say, what does it really look like? Well, black ADX in the last 2 to 3 years looks like, what a surprise, the early 1980s, 1982, 1984. And the second one is in the mid-1990s. I think most people think we're in 1995. We're not. That's not what the charts are saying. The charts are saying we're way down here in 1982. So think of everything we're talking about. Let's say it's all true. You're still going to get counter trend moves along the way that can last 3 months, that could take us through a whole year where the major themes go by the wayside and your inflation and growth things change a little bit. And we just saw that. We just saw that after the breakouts. You just said things changed a little bit.
Look what just happened. I mean, and by the way, in 2016, what created these beautiful charts and beautiful growth rates, and God willing, we're all riding that. I mean, that was our call, growth accelerating. For 9 quarters in a row, the data was reported every day. That was plainly obvious to anybody. The Chinese provided the biggest stimulus in the history of China in the middle of 2016, and the Fed went dovish. The dollar went down. So you had the most epic stimulus that you could possibly need at the point when the most amount of people didn't believe it could happen. So there's a very important moment there that people need to understand as an overlay to everything that you said. But I think you did a good job just going through exactly what happened. I'm just providing the growth and inflation piece on top of that. But what can happen in 6 months, by the way, to one's portfolio without a change in anything you said? Is you can have a 20 to 30% drawdown in an asset class.
You absolutely can. And
you just had it in emerging markets.
And that's where we are now. Your next correction in the S&P 500, it will probably not be 10%. So your magnitude of those starts to get larger the further you get away from the base. So it does get harder from here. And
where do you have the base for the S&P 500 long-term base?
Well, you're really coming off of the bases that I think are the longer the time frame, the more important it is. So an annual chart is a lot more important than a 1-minute chart. Yeah. So the real base here that I think is important, the 2 longest ones are the value line geometric index. That, by the way, is still trying to break out.
I've actually never.
It's close enough to the top of the box that it could be a fail.
But it's not broken out to higher highs yet.
It has broken out. My point is, it's not far enough away from the base yet for us really to feel that we're safe.
Okay.
So you could still come back down under that line. And see, that's another thing that people get a little bit hung up on is everybody wants boxes to break out and everything to be clean. Markets aren't that clean. They'll come back down and go in the box and scare the living out of all of us. Which basically, see, there's some other things that we're missing here too. Remember Brexit, the futures go limit down. Mm-hmm. U.S. election, futures limit down. Have we seen anything like that recently? Nope. It's a different world that we're in now. We're not getting futures limit down. You look at the futures in the middle of the night and they're going,
it's so true.
Barely moving. Jittery futures are jittery markets. And there's another piece we can tie into this. What happens in 1982? So we got a lot of these 1982. Reagan, Thatcher. We get into another political swing where we go to limit bureaucracy, a more limited role of government. We go back to somewhat of now this expression is almost evil right now in the United States. Personal responsibility. That's an era of personal responsibility. You have people here looking backwards. We should move to socialism. The charts are telling you that capitalism's greatest moment, we could be on the verge of it right now. This move could be really, really big, and it could last a long time. And how can these things happen? All multiple expansion is demand. That's what multiple expansion is. Okay, well, how do we get a housing bubble? Well, if you give everybody and their brother a mortgage and they have money, you can drive up the price of any asset. Why is college so expensive? The government made it really, really easy to get loans. It's demand. Same thing with these markets. You have pent-up demand. I don't like the stock market. I don't like the stock market. I saw my parents have trouble. I saw someone lose a house. And this is all real. This is real stuff. And what people don't understand is when you're 10 years old, so if you're 10 years old in the year 2000, you may not know it, but you know that things aren't going well in your house if your parents' 401k just crashed and lost 50% of its value. When you're 15 years old and your parents are worried about possibly losing their house or their job, you may not know that you're paying attention, but you are paying attention. Those are psychological pieces and that recency bias that we have. We're supposed to feel skeptical right now. That fits in nicely. It really does. And there's so many pieces of the puzzle here. And I can't emphasize enough, from our perspective, we are not forecasting here. These are probabilistic statements based on the facts that we have in front of us today. If the facts change, then we have to reassess it. It's a lot like weather forecasting. Your model's probably the same way. How does a hurricane model work? They have multiple models that they run to try to track the hurricane. You'll sometimes see the scatter plots. And then what you see when they finally come up with the path, that's a weighted average of multiple models. What they continually do is they keep plugging in new data into the model. And if nothing changes, they don't change their forecast. If they plug in the latest data and it changes, they change the path. Same thing with all of this. So bullish breakouts, we learn something either way. If the breakouts hold, then we've learned something. If they fail, we've learned something. So if that value line, and I wouldn't get hung up too much on the value line geometric on its sustainability of its breakout, because that's a wide breadth swath. It'd be more concerning if, like, the NASDAQ lost its breakout from 2016, 2017. So NASDAQ starts to break out in late 2016, and it's still holding today. If that breakout failed and we went below the lows of the year 2000, then that would be sending probably a significantly different message.
Yeah.
One thing that you guys mentioned that it's kind of maybe a question for me, I guess, is like you can look at these long-term technical charts, and you have a view of where we're at, and like you said, that there's no straight line getting from point A to point B. In between, there's a lot of pain and there are a lot of emotions involved. You mentioned like pie charts that are probably based on historical data on asset allocation and all that. Do you think that, and you mentioned also like the robo-advisors, like do you think, I personally think that technology hasn't solved the problems that people are still looking at their phones, at asset prices going down, people are still looking and seeing the stock market crash. So no matter if like you said, maybe your pie chart, if you actually hold it, would be fine over a 30-year period, or it has been going backwards, but it still doesn't.
That's a big if.
It still doesn't change the fact that there's people that supposedly are on these automated strategies that's supposed to solve for the human element, but they're still going to look, and you're still making a decision. Is something if your portfolio is down 20%, are you going to sell it or not?
You're right.
Hold on.
The robo is only as good as the person that doesn't hit the sell button or the abort button. That is absolutely right. And none of this is criticizing anyone. We're all humans. So what our job really is we've got our own little psychology experiment right up here. We know the way we think. So I started in this business in 1994. I've either made or seen every single mistake that you can make in the book, and I've made most of them more than once. So what you're doing with these systems and approaches and grids and things is you're trying to minimize the probability of making the same mistakes that we all make over and over again. And your point is extremely well taken. Even if those pie charts do work, and the next 35 years is identical to whatever they're using as their inputs, it only works if you hold it. So in the world of investing, buy and hold works. It's really hard to implement in a major bear market. You have to hold through the whole thing. And the thing that's really crazy is, if you look at, there was a MarketWatch article in, 2014 that was the best strategy for growth. And it was your ultra diversified pie chart. It had emerging markets.
It had everything in there.
It had everything. So small cap, mid cap, growth, all over the globe, REITs, it wasn't a bond portfolio, it was a growth portfolio. We took that portfolio and back tested it. Was it helpful in the financial crisis? Nope. That portfolio lost more than SPY buy and hold. They're all correlated. Growth is growth, and when you get in those things, they all zig and they zag together. The dot-com bubble is a little bit different, but not much better. You can't find much in there that does well. So if your pie chart is growth, it's still going to zig and zag with the markets, and it's not really going to add a lot of value. And then you could say, well, I need non-correlated assets. You do. But what happens if the stock market continues to do well, which is what the charts say? If you have non-correlated assets, you're just giving yourself a higher probability of not participating. Because if the market does this and you're non-correlated, you could do this, you could do this, or you could do this. So when you're actually in these periods where you believe that the market's doing well, you want a highly correlated portfolio to the S&P 500, because if the market goes up, and one of the reasons why, this is another thing that we don't get, the magnitude of the gains that you can get in normal market history is mind-boggling. Nothing special. So when you come off of the lows in the 50s, depending upon where you start, S&P 500 goes up between 300 and 580% during that secular run. Then you go, market needs to consolidate its gains. We go sideways for a long period of time. These are the miserable times to be in this business. They're not miserable. If we go through another one, we'll know it. But when you go through them the first time, you don't know it. You don't know that you're in one of those periods. So it's very, very difficult. When we get to the second one, the S&P 500, from the lows in 1982 to the peak in March, S&P 500 peaks on March 24th, 2000. The gain is over 1,100% in that period, just S&P. So you put the NASDAQ in there, you put some other assets in there. So the moral of the story is, beating the market is somewhat overrated in the long run, because if any of us looked back 18 years from now and we made 300, 400, 500, 600, 1,000%, we'd be turning backflips. But it's hard between point A and point B, because you're going to get the scary, I mean, this is a prime example of what we're going through right now. The longer term trends look wonderful still, wonderful. And it doesn't mean that the last 10 days has been easy. There's a lot of red on our screen. There's a huge psychological element in the markets that systems help you with. The discipline in the system, I call them data anchors. You need a data anchor to get yourself back in line when you know you're starting to act silly. If you're just looking at the red screen and you're just looking at your gain and loss day after day, you're gonna snap and you're gonna hit the sell button. But if you have discipline and something to anchor back to, it can give you a reason. You need a bigger yes in the markets. And what's a bigger yes? So you're old enough, you and I remember 7 Habits of Effective People. Begin with the end in mind. So in this business, what's the end in mind? Well, if you're a money manager, it's, I've got to navigate from point A, January 1st to December 31st, and I want to feel good when I go to the cocktail parties at the end of the year. I don't want to be miserable. I don't want to ruin the holidays. So when I'm in the middle of the year, right now, and I feel like hitting the sell button, I got to think about the end of the year. So that's context. That makes you take a step back off of the daily charts and maybe look at a weekly chart, a monthly chart, a quarterly chart, and get context. So what happens a lot with back testing is, when you back test numbers, you will never, ever, ever plug into a model something like a 50-month moving average, because it's way too slow. It's going to turn really late at the top, and it's going to turn, but context it helps with. So let's talk emerging markets. Emerging markets right now in a long-term downtrend relative to the S&P 500. And what happens to a lot of us is we've got hundreds of ETFs that we can choose from. A lot of times we're reallocating to emerging markets when it's a normal counter-trend move within the context of an existing downtrend. So emerging markets are going to turn at some point. But the next turn, until proven otherwise, will most likely be a counter-trend move against the primary trend, which is emerging markets lagging the United States. At some point that will turn, and that'll flip around and you'll be able to see that. But right now...
Well, a lot of people thought that happened last year. That was the turn. We're on the cusp of a secular bull market in emerging markets, a secular bear in the dollar because of Trump.
Well, think about what we talked about before. Reagan, Thatcher kind of goes to the, move. We're going to less government, less regulation, industry. We want industry to lead. Well, what are we doing now? The switches that we have now are related to globalization. See, a lot of things that happen here, there are a lot of extremes here that we're hitting. We have a whole generation of people that think the United States should move to socialism. That's an extreme. My guess would be that as that goes on, that's going to wane. That movement will not pick up, it will die. Why will it die? Because the economy will most likely do well, and people will get tired of talking about it. And I'm not criticizing anyone. It makes perfect sense that you would think that. Why would you think capitalism works if you're a young person in this world right now? Because it hasn't worked particularly well. But if you would have looked backwards in the 1950s, so you can kind of visualize it on a chart. You get your peak in 1929. That consolidation period lasts all the way into the 50s. The longer you go sideways, the bigger the move you get. Then you have a secular run that lasts into the late 60s. The peak actually comes in 1974 on long-term charts, so like an annual or quarterly chart. But you're already in the consolidation box there. So you're in your move. Here's another really neat one about the 1982 analogy. So here's another one. What about this? Chris, what about this? The stock market bottomed in 2009. So we got this a lot in 2017. We've been going up for 8 years. How can we keep going up? It doesn't make any sense. This bull market's been going on for 8 years. Okay, fair question. If I look backwards in 1982 in the NYSE Composite, so New York Stock Exchange Composite Index, a broad stock index. If I look backwards in 1982, valuations are high. I'm in one of those rear view mirror periods where I look backwards and I say this will end badly, because that's what I know. In 1982, we're in the 8th year of a rally off of a low that starts in 1974. Mm-hmm. Those fractals, if you look at those two charts, they're very, very similar. I mean, the movements are eerily similar of the way you make the low and the way you're in the consolidation box, and that's where you are. So the psychology fits. The stock bond shift fits. The valuation story is it's easy to explain valuations away if you just step through. And how do you do that? You say, if I'm in 1982 and I look backwards to 1881, what is my median PE or my median price to sales? What did I know then? See, what we're doing today is we're using all the data, we're looking backwards and we're saying, oh, this worked here because of this. Well, no, you're cheating, because in 1982 you didn't have the data after 1982. You're cheating. You can only use the data looking backwards. And if you look backwards, they're not good timing tools. They are context tools, but they're horrible timing tools. So you could have said over and over again, 1982, we're overvalued, I'm going to wait, we're overvalued, I'm going to wait, I'm overvalued, you're going to wait. Guess what? We never go back to those levels, have never been back. So we may be at those type of levels today where you never go back to that breakout in 2013 in the S. Never. I mean, never. Have we ever gone back to the low in 1929? Nope. Have we ever gone back anywhere near the low in 1984? We've gone nowhere near it. So open mind is the key. You should keep an open mind about better than expected outcomes occurring for a long period of time. And there's nothing that we've seen so far from the beginning of this to here that enables you to poke a giant hole into this theory. Now, counter-trend moves, fractals, sure, you're going to be able to find short-term evidence all the time that counteracts it because you're getting counter-trend moves. So leadership has a counter-trend move. If tech is going to lead from 1982 to 2000, that doesn't mean technology stocks lead every day, every quarter, every month, or even every year. You got to have a counter-trend move in there. And then when we get these pullbacks here that we have, no one likes them. If you're long, I'm really long. It's not fun, but it really is good. Why? If it keeps going up every day, we're moving further and further away from a base, and it's getting riskier and riskier and riskier. The market needs to consolidate its gains. You need these pullbacks. What happens during a pullback, if you really think about it? Someone's liquidating. They have to be. I mean, someone's selling. It's not even that. We're always, it's the conviction. Markets move based on spreads. So there's always a buyer and seller. We know that. That's obvious. So when you hear there's more sellers than buyers, that's ridiculous. There's two people on every side of every single trade. It's the conviction between the two that moves the spreads. So when we correct here, that means there's a group of people that their conviction to sell is increasing. Their conviction to sell becomes greater than some people's conviction to hold. So someone on the other side will buy that. My point there is, someone's raising cash. Someone's sold to get out. Well, many of those people will come back in and push these markets higher. That's where that money comes from. If you liquidate and you're wrong, you eventually have to get back in. And that's another thing about liquidating. When you liquidate, you have to be thinking about, how am I going to get back in? That's rough. So let's say you liquidated during the 2-week period between the peak in January 26th of this year, we peak, and we bottom in February. It's really only about 10 days of market trading of there, and then we hit the low. If you're liquidating in there, it is rough to try to get back in. I mean, we are up and down, over, up. You know, there's never a point where you would say, hey, it's time to get back in. We've never had one of those, and that makes sense. When you get a dislocation out of a strong mathematical profile, you usually make a new high. And usually off of that low, it's a mess. It's a mess. The market's confused. What we just went through is like a little mini microcosm of 1987. 1987, you come out of a strong mathematical profile, you tank, and if you look at that low, we used it as an analogy, and I looked at the 1987 low and I thought, how am I going to get back in? This is brutal. You get breakouts, false breakouts, false breakouts. It's really, really rough. So thinking ahead a few chess moves is really, really important. And of course, there'll be some points in history where you have to sell. Mm-hmm. The data is now hitting the point of, the way we think of it is this way. If this is a long-term secular trend, we know it's going to go up, it's going to go down, it's going to go up, it's going to go down. What is an uptrend? A series of higher highs and higher lows. You're always going to have counter-trend moves. So your goal and your objective is from a long-term perspective, but this works on shorter time frames too. So if you're trading, it works too. With fractals, your goal is to differentiate between volatility to ignore within the context of an ongoing uptrend, and eventually we're going to get to volatility to respect, where the data is going to say, you can't just sit there and take it anymore, because asset class behavior, your trends now, your hard data is all rolling over, and you've got to start taking some action.
Yeah, that's great stuff when you get down to the screws of how you think about the market, how you contextualize the market. I think a lot of people that watch you and pay attention to you obviously are doing it for good reason. You're like an encyclopedia with all this market knowledge. So it's important, and it's important for all of you to maintain your own time series, understand the history of it all, understand the relationships between time and price, and why certain things happen, so you can recalibrate every day. And as Ciovacco just said, every day your best position is to improve your position. Okay. So thank you for taking the time.
Appreciate the invite, gentlemen.
Thanks, Chris.
Yeah.
Enjoyed talking with you, and I always enjoy coming up here. They've got an office full of hockey players.
Yeah,
so I love it.
It's one good thing about this place, according to some people's data.